mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. First question is from Gary. Gary asks, what will happen if inflation takes off and the Federal Reserve raises rates again? So Gary must have gone to the income first, growth second approach already, but he's worried. What if they raise rates? All right, Gary, that's a great question, and it could happen. There's still some concern people have about tariffs. Will the tariffs cause more inflation? So far, we're not seeing it filter through, but we're only, 5 months into the tariffs, right? So it could happen, but also just lowering interest rates stimulates the economy, and that alone could generate inflation, as you're apparently aware, right? So all of this could cause inflation, which means now the Fed's got to reverse course and hike interest rates to slow down the economy, to kind of stop that inflation. And I said, I've said in past shows that, the Fed's trying to kind of get past the reputation of always being too late and trying to get ahead of it, but they might be too late. They might be too late, and we could actually go into a real recession, which means the economy slows down, they lower rates more, or we could be too early. They could have reacted too quickly, and that causes inflation. So, Gary, the question is how you pivot to an income first, growth second mindset. We all know that, as Warren Buffett says, and I quote on this show all the time, when interest rates go down, the value of most financial assets go up. When interest rates go up, the value of financial assets typically will go down. So that's the nature of your question, I'm sure, right? So if you own bonds and preferreds, they're 100% mathematical, right? Bonds are a great example of where interest rates go down, they go up, interest rates go up, they go down. The inverse relationship is crystal clear. But there are other income first, growth second approaches that can help you navigate these uncertain waters. For example, dividend stocks, right? Dividend stocks. Oftentimes, when there's periods of inflation, they can pass that high inflation through to the people buying their goods or services on the end, and therefore not necessarily adversely affect the dividend or the value of the stock, because they can pass it through to the consumer. Bad for the economy, but okay for the stock. Now think about companies like utilities, consumer staples, established companies with pricing power. They often maintain or even grow their dividends during inflationary periods. Also, there are other income generating vehicles to consider. Business development companies often have floating rate loans inside of them, which can do well in a rising interest rate environment because their loan rates adjust upward with market rates. And to some extent, so do real estate investment trusts that oftentimes have pass-throughs or leases tied to things like increasing interest rates or inflation adjustments. Many REITs have built in, escalation clauses that help protect against inflation. Another strategy worth considering is Treasury inflation protected securities, or TIPS, which adjust their principal based on inflation. While they might not offer the highest yields, they provide a direct hedge against inflation eating away at your purchasing power. Now, you might also look at commodities or commodity-focused funds, as these often perform well during inflationary periods. So the bottom line is, if you want to hedge your bets, you're smart to be in an income first, growth second mindset, but just don't go all bonds. If you knew rates were going to come down, you'd want to buy all bonds and preferreds. And hey, you might get a good bump in the value and you've locked in your income for the long term. But if you think rates might ricochet back up again, then you want to have the ability for the income to come back up or the ability for your assets to go up with inflation. The key is diversification within your income strategy. You want some fixed rate instruments for stability, some floating rate for inflation adjusted investments for protection, and some equity-based income that can grow over time. This way, you're not betting everything on one interest rate scenario. So again, Just be smart how you do that. Utilize some bond-like stocks, not all bonds. Use a lot of dividend-paying equities, some floating rate instruments, and maybe a small allocation to an inflation hedge. And you'll probably have a pretty good mix to protect you in either direction while still generating the income you need in retirement. Okay, that's an awesome question. And if you would like to send in your question, you can do so. You can just email it to us. You can email it to poolelock@poolelock.com. Moving on, our second question is from Liam. And Liam says, in anticipation of rates going down, I went to lock in long-term CD rates, but I could only find good rates on the short-term CDs. And why is that? All right, Liam. Well, the reality is that we've had that problem for a while because the banks were anticipating the Fed was going to lower rates. So they didn't want to lock into a long-term CD with high rates. They'll give you a teaser rate, and now think about it. If they offer you 8%, right, that'd be ridiculous, right? For 8% for 6 months. All they're really doing is giving you 4%, right? Because that's half a year and at 8%. So they can do that, get a teaser rate, get some upfront money, and hopefully it'll automatically renew. You'll forget about it, and they can keep the money and lend it out. But for a while, they've known rates would be coming down. We all suspected that it would eventually happen, and therefore don't want to make that long-term guarantee. And besides, banks don't like to do that. They don't like to commit long-term. They would like you to commit long-term. You get a 30-year mortgage. They want to have a fixed rate or a long-term loan where you're paying a fixed rate, you're committing to them, but they don't want to commit to you. It's a function of banks. And it's really about their risk management and profit margins. You see, banks make money on the spread, the difference between what they pay you and what they can lend the money out for. If they lock it in at a higher rate with you for 5 years, but then rates drop and they can only lend that money out at lower rates, they're stuck in a losing proposition. That's why they'd rather give you that attractive short-term rate and then hope it resets to a lower rate when it matures. And besides, Liam, if you're trying to get long-term income, CDs are probably not the answer anyway. There's a whole universe of bonds and bond-like instruments that could help you in that regard if you're trying to transition to an income first, growth second mindset. Think about treasury bonds, corporate bonds, municipal bonds, bond funds, maybe ETFs, right? These instruments are designed specifically for longer-term income generation and often offer better rates than what banks are willing to commit to on long-term CDs. For instance, you might look at treasury bonds with maturities that match your income needs. If you want income for the next 10 years, you could ladder treasury bonds so that one matures each year, giving you both income and the return of principal. Right? Corporate bonds might offer higher yields, though with slightly more risk. Municipal bonds could be attractive if you're in a higher tax bracket, since the interest is often tax-free. There are also bond-like stocks to consider. Things like preferred stocks, REITs, business development companies, utility stocks that focus on paying consistent dividends rather than growth or capital appreciation. These can often provide better long-term income potential than CDs, though they do come with more price volatility. Now, when are CDs applicable? Well, if you have a lump sum goal, in a year or two, you want to buy a car. You want to do something specific. Well, now you can afford to have you can't afford to have the money fluctuating. It's a short-term goal. So you want to be safe. Then the question is, how much interest can I earn over that time, over the next year or two, or if I'm going to cash this out and buy a particular thing, right? It could also be if, let's say you've got a college education coming up and you want to have a child who's a freshman in college and you want to put some money aside for that sophomore year, their junior year, their senior year. Well, that's where the CDs come in because, again, you're going to clean it out, that entire CD, and pay the next year's tuition and then clean it out, another one to pay the junior and then the senior year and the predictability of a CD outweighs the need for higher returns. So CDs can also be useful as part of your overall asset allocation, maybe as your safe money component. Alongside your income generating investments, they can serve as your emergency fund or your short-term income investments, to kind of do their work, right? So that's the purpose of CDs, and that's why, although it doesn't really matter if they don't commit to high long-term rates for your specific retirement planning, right? For a retirement income, you want to think bigger picture and look at the entire spectrum of income generating investments that can work together to provide you with the steady cash flow you need. Hey, great question. If you have a question you would like to send in, you can do so by emailing that question to poolelock@poolelock.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source, and I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the